Part of why I do what I do is because I believe that the US markets in particular are broken.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. As mentioned many times on this program, stocks started the year trading at or near record high valuation extremes. When stocks look potentially overbought like this, short sellers smell opportunity. Today we've got the good fortune of speaking with one of the best known short sellers in the business, Carson Block, founder of Muddy Waters Research. Carson, thanks so much for joining us today.
Yeah, thanks for having me, Adam.
Hey, it's a real pleasure to have you on the program. This is your first time. It's very nice to meet you virtually here through the inner tubes. Look, it's got to be a really interesting time for somebody in your line of work. And I've got a lot of questions for you, sort of about the role of short selling and what you see in terms of this market that we have. A lot of people out there, a lot of the guests in this program have been saying that it's a overbought market. And so you might assume that might be a target-rich environment for somebody with your expertise. Now, obviously, you look at companies where you think the stock price might go down, not necessarily because of just valuations. Oftentimes, your firm does a great job of sussing out companies that are, conducting fraud or vulnerable for other sorts of ways. So we'll get into all that. I also know too that you've got strong thoughts on things like China, uh, other parts of the world and parts of the markets where you see opportunity right now. I think Asia is one of those. There's a lot going on, obviously, with the new administration that I'm guessing you probably have some thoughts on that and the implications of some of the new policies that have been released. So we're going to get through all of that. But if we can kick this off with the general question I like to ask people, especially when they're new to the channel, what's your current assessment of the global economy and financial markets?
Well, okay, they're not necessarily the same things, right?
Nope.
The economy could be going one direction, markets in another. Um, so I'll start off talking about the US markets. Part of why I do what I do is because I believe that the US markets in particular are broken. There are various reasons they're broken. One reason that's maybe among the more obvious is that ever since the financial crisis, we've had emergency monetary policy in place for well over a decade. Whether we are right now still at, the Fed seems to believe we're above R-star, the rate at which stimulus ceases causing asset values to grow, but I'm not so sure when you look at highly speculative assets like crypto, et cetera. But
Mhm.
um, that's one issue. Okay, so risk is underpriced perpetually, and that was what policymakers wanted to do coming out of the GFC. They just really didn't take their foot off the gas until 2022. Now, one of the other ways in which the US markets are broken is passive, and how passive investing has warped the markets, especially with respect to stocks that are in indices. So it's that's something else that is problematic. Now, it's been great if you've been long the S&P 500 in general, and on a short-term basis. So I think because of the impact that passive has on indices, especially the S&P 500, you can't, I think it's anachronistic to try to talk about whether it, those are overvalued, the S&P 500 is overvalued or not, because effectively what happens, and this is maybe going a little bit too far down the rabbit hole here, so I'll try to nutshell it. But when passive buys a share of a stock, it buys it from an active holder. Okay, so now passive owns it. And that share is essentially removed from the float. That share will never be sold unless and until passive has outflows that it has to meet. So
Mhm.
until we get to that situation, you're just perpetually shrinking the floats of these public companies. But guess what? Passive comes back the next day and buys. and they buy it, it buys at an even higher price because passive does not care. And the buying of names that are more heavily weighted begets more buying of those names because the market, the indices are generally, especially the S&P 500, are market cap weighted. So that dollar that flows into passive, more and more of it is allocated to the largest names in the S&P 500. And that makes the stocks go higher, all other things being equal. So that means tomorrow, even more of that dollar gets allocated to the largest weightings in the indices. So I don't think you can have a real conversation. I mean, you can converse, but I don't think it really means anything to try to figure out, well, is the market overvalued? Because at the end of the day, what I see driving the market so much, these technicals and these flows of funds, the robo bids that do not care about the fundamentals. So that's the state of the US market.
Okay,
The
and sorry to
rest,
interrupt, but it's sort of don't criticize the bug because you're saying it's kind of a feature at this point.
yeah, I mean, look, it obviously wasn't what was intended. And Jack Bogle, not too long before he died, he did he did warn. He said, you know what, passive has become larger than I ever thought it would be. It's become too large, and I don't know that he was really focusing on on that effect. Which by squeezing the floats perpetually, you're getting this parabolic impact on stock prices. I don't know if he was focusing on that even so much because that's not really that widely understood or discussed, even though when you lay it out like that, I mean, I think it sounds kind of intuitive. But yeah, I don't, it sounded like Bogle never really intended for passive to become so large as a percentage of managed assets.
Right, that the tail would
So
start wagging the dog here. Yeah, yeah,
yeah,
and
the
I shouldn't
tail's
have said
wagging the
don't
dog.
criticize the bug, but I think what you're saying is don't pretend like it's an aberration that, oh my gosh, stocks are overvalued here. It's because, well, of course, because that's the natural, inevitable result of this increasing dominance of passive.
Right. And so when you look at other developed markets like Europe, it seems like they're trying to catch up, and passive is becoming larger there. So the problem, I mean, this is all well and good on the way up. So I do think that when you're in, because if you, let's also tell another truth about the couple of more truths about the S&P 500 index or the index for any developed market that does start to have a lot of passive in it. So first of all, those indices, we call them passive, but they're effectively actively managed, right? They drop lagging names all the time and add up and coming names. And also, again, because of in the US, because of this impact that passive investing has had, effectively now the S&P 500 is like a momentum index. And so, it seems like the rest of the world is trying to catch up to that. And this is great on the way up. It substantially increases the fragility of these markets. Now, I'm not saying we're going to have a catastrophic correction anytime soon. That's unknowable. But when we do have a correction, it will probably be pretty massive because you're going to have passive selling at any price, right? So if you have these flows reverse and people are hitting up there, and the big buyers in the US, the big passive buyers are the target date funds, the 401k funds. So if people start hitting up their 401ks, pulling money out, you have significant unemployment increases. So fewer people are contributing to 401k funds. Then at that point, passive has to puke and it cannot be selective and say, oh, I'm going to wait for a better price. And since so many active managers have been put out of business during the past, decade and change by this accelerated rotation from passive to active, there's not a lot of money sitting on that's going to be sitting on the sidelines ready to catch the falling knives. So it's, at this point in time, I wouldn't worry, I wouldn't panic about this. And we're obviously seeing some volatility. I don't think we're at the point where the flows are really going to reverse. But yes, if we get to a point where you're looking at real unemployment increases and layoffs and people cashing in their 401ks early, then you have to start thinking about that.
All right, so is it pretty much then going to take a recession to trigger this, or because it seems like it's very employment dependent, right? You need to have a reduction in the size of the passive flows, and then perhaps unemployed people starting to having to withdraw from their 401ks, perhaps even early.
Well, but then of course, what is the policy reaction every time we have a slowdown?
Yeah,
It's to
massive
cut
stimulus.
rates, yeah, to cram liquidity into the system and add leverage. So, that I'm sure that's still the playbook. I I don't know enough to have a view as to, I mean, you have to kind of figure it out when we get there in terms of the whether the layoffs and the decreased flows into passive are going to be offset by monetary stimulus. I mean, it kind of depends on what are the policy rates in effect at that time. I mean, there are a lot of fundamentals that'll go, or a lot of economic factors that will go into determining that ultimately. But look, the playbook, obviously, whenever there's an economic dislocation, the playbook that we run is, I call this the powder keg economy. So you build a keg, you stuff a bunch of powder in it, which is leverage, and then eventually it blows up. Well, you then build a bigger powder keg, put more powder in it, and it too blows up, and so on and so forth. So in theory, at some point you get to the stage where you can't do that, or it's not going to be effective anymore. But just like what I'm saying about passive and the markets, when do we get there? Unknowable. In general, I think it pays to stay long. So for most investors. So yeah, I wouldn't worry too much about this turbulence that we're seeing right now, at least from the perspective of the markets. That's short term. I mean, maybe it's a vote on the politics or the political or geopolitical situation. That's a different matter. And, maybe that's something that we should all pay more attention to. But as far as the markets go, I think this is short term. The short term chop is probably just noise.
Okay. To your point about this powder keg market, it sounds like you think at some point there's an explosion that's so big that it forces sort of a real change. But on the way there, there's this series of explosions, rescue, explosion, rescue, explosion, rescue. Um, do you, I mean, I get the sense you're not staying up late worrying about the big one happening tomorrow, but do you think investors should be preparing in their mind that, okay, we're, somewhere here, we've got that final explosion coming up, or should they be just preparing for more of the explosion, rescue, and it's going to be a good while before we get to the big one?
Well, there were certainly, okay, so if we look at the somewhat recent chronology, starting with 2001, okay, the internet bubble bursting, everybody knew it was a bubble, like it's inevitable it bursts at some point, didn't
Hmm.
necessarily know when. But you could have seen that coming, could have dialed back your risk exposure, could have avoided NASDAQ 100 names or other tech names. That was foreseeable. '08, foreseeable. Um, I mean, look, a lot of people, myself, nobody knew who I was at the time, but say 2005, a lot of people were really concerned about this. I remember Morgan Stanley's economist, Stephen Roach, had
Hmm.
been writing for years, leading up to the GFC, about these imbalances and the problems that were brewing. So that one was foreseeable. And then, hey, when the Bear Stearns funds failed in '07, and then you had this weird thing where a bunch of quant funds had blowups and semi blowups, because it turns out that all these black boxes that are supposed to be doing these unique things are all actually doing the same thing, but there were some weird macro events that set them off. Those were canaries in the coal mine. Bear Stearns itself failing in March of '08. I mean, like I pulled all of my money out of the market at that point.
Right. I mean, that was a wake-up call. Yeah.
Yeah, that was. So that one was foreseeable. COVID, not really. So most of these are foreseeable events, and you can see that it's a slow motion car crash. COVID, no. The next one is, just statistically speaking, is probably decent bit more likely to be one of these slow motion car crashes as opposed to, a pandemic or what have you. But yeah, or a war. I mean, that's the other one to watch out for, right? I mean, if there were a kinetic war with China, that could be problematic because we need to keep in mind how China owns hundreds of billions of dollars of USD denominated paper.
Right.
And if they really wanted to go nuclear from a financial perspective, they would dump that on the market. Now, of course, they would experience significant pain from doing that. But yeah, I mean, that's, so that's something else that I think you have to kind of watch out for is just, are we heading toward that sort of horrific scenario? Hopefully we're not, but I think usually these things are foreseeable.
Okay. All right. So, you said earlier, hey, for most people right now, given where we are in the cycle, it still pays to be long. So you're not telling people to rush to the hills. You're definitely doesn't sound like you're telling the average investor load up on shorts. Now that being said,
I would never,
I
ever, ever advise the average investor short. So.
okay, great. And I was going to give you a chance to talk about that, but yeah, I totally appreciate why. Okay, but as I mentioned in the intro, you are very well known as a short seller. Um, in the intro, I talked about, starting the year at least. I mean, the valuations have come down a bit now, but they're still pretty rich. But they were very, very rich at the beginning of the year by lots of different valuation metrics. Um, so I want to get the sense for how you sort of see that world as a short seller, but maybe before answering that question, can I just ask you the question of how do you see your role, you and your firm's role, in this ecosystem, right? I mean, in some ways, I think you can make a really good argument that short sellers, they're a really important part of the ecosystem. They're very helpful in achieving price discovery. Um, Especially in a market where things tend to be richly priced, um, you know, uh, some of that can be for very undeserved reasons, fraud being a good example of that. And so you actually really want to have short sellers out there kind of picking off the worst of the offenders. But anyways, how do you see it?
Well, I think it's important to understand that short selling, well, there are very few professional short sellers around anymore. But the vast majority of short selling is what I call traditional short selling. So it's usually fundamentals based, that the short seller perceives that XYZ company is a melting ice cube and it's going to take a short position just based on the fundamentals deteriorating. And it's not going to talk publicly about it. I mean, there's honestly no reason to discuss something like that publicly. So that's the vast majority of short selling. The short selling that occurs today along those lines, the twists are that it's almost entirely carried out by long short funds that are usually net long. So having a short book enables them to be long more. Um,
It's more of a
because
hedge, is what you're saying, right?
correct. They use those as primarily as hedges. I mean, sometimes they have what are called alpha shorts. If they think a company or, is just so crummy or is a fraud, they'll take a short position. But and actually after the meme stock phenomenon in early 21, a lot of the long short funds stopped doing single name shorts and they just went to index shorts. Now, I think some have waded back into the water, but there's still a lot of apprehension in long short world about single name shorts. Now, what I do, I'm an activist short seller. So we're not interested in melting ice cubes. We're interested in companies usually where the management has significantly misrepresented state of the business, the financials, transactions they've done, or the company itself is doing something deleterious to society or its customers. And so what we do as activist short sellers is we combine effectively journalism, investigative journalism, with an investment strategy. So we pay for the investigative journalism by taking short positions in those names. So again, the universe of companies that are interesting to us as activist short sellers is really just a fraction of the shortable universe, whatever, one thinks that is. So, we like to think that, I used to say this and people thought I was joking, but when ESG was kind of in vogue, I was saying that, hey, if you really care about G, which nobody cared about G, like they only cared about E, to be honest. But
Yeah.
if you really care about G, activist short sellers, we are the purest form of governance focused managers that there are on the planet. Or governance focused investors, since actually most short activists don't manage money. Muddy Waters Capital is, we do manage private funds. So we're an exception to the rule.
It's interesting, the term sort of an investing vigilante comes to mind, where you guys, you find a company that is misrepresenting itself, misrepresenting its value, is unfairly valued given what it's actually doing, and you say, you know what, I'm not going to stand for that. I'm going to right this wrong, and you get in there and you do your thing.
No, that's a fair comparison. My path to getting here was somewhat circuitous, but I grew up in the investment industry. And it's funny because so my father was a sell side analyst, and he focused on micro caps and small caps. And he also was an institutional salesperson. So, he controlled the distribution of his ideas. But I found out, once I started doing this in 2010, that my father was generally considered to be one of the most bullish analysts, if not the most bullish analyst on the street. I talked to one journalist who told me that he had taken a sabbatical years earlier from journalism, worked at a hedge fund for a little while, and they had a strategy in which they shorted everything my father ever put a strong buy on. So, but my father wasn't in on the joke. Like, he genuinely believed in the charisma, or he was taken in by the charisma. Because I worked with my father for a few years when I was in middle school, high school, spending summers on Wall Street working with him. And then I worked with him a little bit after I'd left a large investment bank, shortly after college, and I worked with him for a couple of years. And so I saw how the charisma took him and other people in. I saw how these managements were using us and our clients to enrich themselves. And back then, they had 45 days to file their Forms 4. So it's happened a few times. I'm talking the 99 to 02 time period, where we would take these companies on non-deal roadshows, and our institutional clients, would be buying the stock up. And then we'd see eventually the Forms 4. It's like, oh, great, management, you dumped, blah $1 million of stock while our clients were buying it. What's the deal? Oh, don't worry about that. Just need to diversify. And this was great. This was a company in Houston called Tidal Technologies. They made off-premise ATMs. And I was upset at them because they weren't giving us answers. And after we'd taken them on this non-deal roadshow and they sold their stock. And so I finally got the chairman, Jim Rash. He's passed away a long time ago, so you don't have to worry about defamation suit or anything here. Got him on the phone, and I was just like, Jim, like, I've been trying to get a hold of you for a week and a half. So this was 2000 or 2001. And he said, Carson, we're moving at internet speed down here, which, anything but, right? So I was so embittered by this by this experience. Okay. So we were long a company that ended up being adjudicated a fraud. It was called Rentway. It was later bought by Rent-A-Center. And I just hated stuff like that. The CFO, I think he got less time than the controller underneath him. and the CFO goes to prison, like finds Jesus, comes out and is a respected member of the community again. And yeah, I don't know. It just none of this stuff sat well with me. So by 2002, I threw up my hands. I said, I always wanted to be an investor, but I just feel like we're constantly being abused as investors by
Mhm.
these managements. And so I went to law school. At the time, I had this amorphous notion that going to law school would give me tools to better help protect myself against what I saw as financial predators. And, I ended up really enjoying law school. So I ended up practicing law and then starting the first self-storage business in mainland China. So I'd been out of the market for 9 years by the time I started Muddy Waters. And I started Muddy Waters because I came across just this one fraud based in China that was listed in the US. And it's kind of an accident, that I came across this. I put out a report, not knowing that, if anybody would care, and sent it into the ether to 50 people I used to talk to in the markets. And it became a business. And it turned out that there were hundreds of frauds from China listed in the US. So in those early years, you talked about my being a market vigilante or something along those lines, but the word vigilante, yeah, in those early years, I mean, a lot of this was psychotherapy, like just exposing these guys. I mean, it really, it almost didn't matter whether I made money or not. Like it was my way of getting back at these people. So
I'm going to
now,
guess that you get a lot of kudos from people who sort of like you, but stayed in the financial industry and just kept getting fleeced. There was probably, I'm guessing, a lot of people kind of cheering you on in this, correct?
oh, I'd say by numbers, I mean, look, I used to say, and it wasn't entirely a joke, but I used to say that one of our KPIs was death threats. Like how many death
Okay.
threats were emailed to our info at Muddy Waters research box. And,
Right.
if we weren't getting many, we probably weren't being very effective. So I don't know. I mean, every now and then, I meet somebody who says, "Oh, I love that, you guys do XYZ," but I mean, 2025 is very different from 2010 as well. And I talked earlier about just the underpricing of risk. I mean, before COVID even hit, I was, raising money for one of our funds in, January of 2020 at this investment conference. And the line I kept using, I'd been using it since late 2019, was all of this monetary stimulus for all these years has anesthetized investors to risk.
Hmm.
So it's done that. And so when you have markets that are filled with participants who are largely anesthetized to risk, no, we're not very popular people, I have to tell you. And it was kind of a shock to me when the meme stock thing happened. And one of my contemporaries, Andrew Left of Citron Research, he was the public face of the GameStop short. And as they squeezed the stock up on him, you just like on Wall Street Bets, the Reddit forum and all over the internet, they kept referring to us, the short sellers, activist short sellers, as the suits. And it was this crazy moment because I always viewed us in what we activist short selling as being countercultural
Right.
in finance. Like we are the front lines of any countercultural movement within the financial markets, and to suddenly be derided as being part of the system and being suits, I don't know. Things are very different from 2010. Like, what can I say? So
Wow.
I don't know that we're really that popular.
Well, I can tell you from running this channel and this platform that there's a lot of ire amongst the regular investor that they feel like they get fleeced and taken advantage of by a lot of these same Wall Street folks that you were talking about. So we'll know when this video goes live in the comment section about how folks think. But I'm going to suspect you've got more folks cheering you on out there than maybe it feels like on a daily basis. So, anyways, you said 2025 is very different than 15 years ago. Um, I mean, is it a target-rich environment for you? Is that not? I mean, as we have these high valuations, as passive keeps pushing everything up, yeah, it may last for a while longer here, but I mean, again, that speaks to valuations maybe being higher than they deserve to be. I don't know what the fraud situation's like. Like we probably washed out a lot of the Chinese fraud that you were talking about earlier, probably largely due to your efforts. Do we have cleaner streets in the financial markets these days, or are there still a lot of, bad actors out there?
Well, so I've long maintained that the bigger problem in terms of scope, number of incidences, value of the problem, is I'd say it's the stuff that's not illegal, right? It's the things that are maybe just on the right side of the line or gray areas. They're unethical. So lots of companies misrepresent their numbers, or they spin narratives that are misleading. But unless you get the email in which they're laughing about this, like, ah, ha, 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 these projections, there's no way we'll ever hit them. They're not going to be held, they're not going to be held criminally liable or even civilly liable in an SEC action. So, and I think that this environment, it's been so corrosive for so long that to me, it feels like that type of behavior, the exaggeration, the manipulating your financials, which all of these to me are abusing investors. It seems to me like that's maybe the norm. It's certainly become normalized. I and I've said to myself for a number of years that for a lot of these CEOs on whose companies we publish, the moment, in the moments after we publish, at some point they probably think like, why me? Like, what am I doing that all these other people aren't doing? And,
Mhm.
the answer is, I don't know, your number came up. Like it's, if that's what some of these CEOs are thinking, they wouldn't be wrong. I think I think it's just so normalized. And, and the incentives to do it are massive after all these years of monetary and also fiscal stimulus. I remember now I'm talking, fraud land, but I think the analogy applies also to just financial engineering as well, or whatever you want to call this, the gray zone type of behavior. Back when I started doing this in 2010, if you stole $50 million, like, you got a seat at the big boys table. Like if you were able to cash out 50 bucks, that was real money. Today, no, that does not put you like you're maybe at the middle school kids table with that. I mean, the people, hundreds of millions of dollars. Like we routinely see people fleecing investors and selling for themselves hundreds of millions of dollars of stock in the billions sometimes. So it's the incentives are just so massive. And it's kind of funny because academics have really screwed this world up in a lot of ways, as have lawyers. That lawyers are number one, academics probably two or three. But in the academic mind, it's like, well, why would somebody do this? That engage in this promotional behavior and basically mortgage the company's future for the sake of printing a few good years of earnings. That doesn't make sense, especially when we give these managers all this equity. They have all these long-term incentives, to get them focused on the business for 10 years. It's like, now in the real world, okay, when you can ride off into the sunset $150 million after 4 years, yeah, that's a number that will get you to do things you shouldn't do. And, I think that analogy also applies to how our corporates have engaged with China over the years. Okay, so the fact that you go into China, you transfer in IP, you've got a joint venture partner and your IP ends up getting stolen and they end up competing with you, 5, 6 years down the line. Like, that was lost on no one at the C level who made the decision to go into China. It's just, it didn't matter because everybody wants me to have a growth narrative. China's
Right.
the easiest, most common growth narrative. That's going to keep me in my seat for at least a few more years. I'm going to get a bunch more stock. I'm going to be able to sell it. And, that competition that we're creating 6 years from now that maybe will bury our company at that point in time, I won't care because
It'll be someone else's problem. Yeah.
I will have made $300 million and I'm out. So that's, that's how I think this stuff works in real life.
I mean, I'm sure there's a lot of people watching this that are this is just making their hearts heavy, not because they didn't suspect it was happening, but because they did, and you're validating it, right? You're telling them that their fears are actually accurate.
It's worse than you thought.
Yeah. Let me ask you a couple of targeted questions here. So, there are, as you said, it's not necessarily so much folks doing things that are blatantly illegal, but it's things that are in the gray zone and yeah, you can maybe argue are morally or ethically not right. Um, what role, if any, do you think buybacks play in this? Where, it's become corporate culture to say, hey, the best thing we can do with our excess cash here is just to buy back our own shares. Of all of the entire universe of things that we could do, we've determined that buying back our shares is the number one best thing we can do. And yeah, if I'm a corporate executive and they're buying those shares back from me, well, so be it. But I mean,
Yeah.
isn't that just sort of a very legal vehicle to do this rinse, wash, and repeat?
Yeah, absolutely. So I think that also touches on that discussion that we were having earlier about the impact of passive on markets and flows, how flows are dominating markets. So if your company is in an index that's getting a decent amount of flows, and therefore your stock is getting that passive buying, layering a buyback on top of that is very powerful in terms of pushing the stock price. And then, yeah, what you were saying, it's, with senior management selling their shares into these buybacks, they're buying low and selling high, to the company. Yeah, I mean, that's so clearly problematic, but at the end of the day, that's not hidden from investors. And so that goes back to my, that phrase, people are anesthetized to risk. Like they don't care. I've been in the market. You could say, at the very least, you could say I've been in the markets for 31 years. I got my Series 7 in 93 and 31 and a half years.
I got mine in
And
94, so it was right
okay,
behind you.
yeah. And I remember how non-GAAP started in the US, right? So it was during the internet bubble days, 99, 2000, and FASB required that companies start expensing the costs of equity that they were, whether they be options or share grants. And and my father was just furious about that, right? Like he's a sell side analyst. It's like, oh, that no, I just ignore that. And all of Wall Street wanted to ignore those non-cash charges. And so companies began giving out their non-GAAP earnings or non-GAAP losses. And well, um, and that culture grew. So now everybody hangs on these non-GAAP metrics or adjusted EBITDA, and there's so many ad backs. I mean, these things can become so divorced from reality, but that's exactly what the sell side will talk about when they evaluate the companies and when they value them. That's exactly how the buy side thinks as well. It's in terms of these, these lie to me metrics and numbers. So yeah, it's, that's kind of what the market wants. The market wants this aggression and this gray zone stuff.
Right. Well, it
And
likes the happy dream as long as the number go up, right?
yeah, exactly.
Yeah. So, all right. Well, then Carson, by the way, it's a fascinating conversation. So thank you so much for this. Let's get to the so what then. So, you know, presumably this can't continue forever, and you've already sort of categorized the market as a powder keg market. So its destiny at this trajectory is some big breakdown beyond which we just can't repeat the inflate rescue cycle. Um, what what reform would you like to see in this market that might put you out of business eventually, right? But maybe that'd be a good thing, right? You could hang up your vigilante, pistol, and feel like you made the world a better place. So what type of reforms would you like to see implemented in the financial markets?
Okay, well, first, just comment on that. I've long said, hey, if markets normalized and you didn't have so many companies being so aggressive and manipulating the information, I'd be the first one to say, hey, let's go and look for stuff to buy. And in
Hmm.
fact, I'm doing that now. And we've got funds where we're doing that in Vietnam. We're on the long side there. Also, metals mining, not crypto mining. But in terms of reforms, well, look, one thing, obviously, and I don't know exactly what the specific policy prescription for this would be, but there has to be something done to cap the amount of shares that passive investors can buy. Now, again, that's a statement of principle. I don't know how that would work in practice, and that could also create other distortions. But that's one thing. Another issue is that enforcement against corporates has become almost non-existent. And there's a great book that was written by an investigative journalist. He's with ProPublica now, Jesse Eisinger, and it's called The Chicken Shit Club. And it
I
covers
remember that when it
how,
came out.
yeah, basically post Enron, after Enron, a lot of people in the government and the Department of Justice thought that the government went too far in pursuing Enron and also Arthur Andersen. And I'm not entirely opposed to those points of view, because I do think that a lot of what happened with the Enron prosecutions was political. I mean, my take on Enron was it blew up because of leverage and the gray zone accounting. So the stuff that was legal that they were doing was much, and is still legal today, is much more responsible for Enron's blow up than the fraud. But it blew up, and then as they sifted through the wreckage, they found these relatively small incidents of fraud, and for political reasons, they prosecuted. But so that, unfortunately, while there was some overreach there, and look, this is the case with human beings always, right? Throughout our history, is we don't calibrate properly, we overcorrect. And so we've been in this era for the past 20 some odd years where it seems that there's really no enforcement against corporates, at least meaningful enforcement. Um, but the flip side of that is that instead we just create a bunch of checklists and paperwork, and that all serves to build in plausible deniability for the people who have enough lawyers or money to pay the lawyers. And it's a far from optimal outcome. So I would like to see much heavier enforcement. I think also one of the things that's really problematic is the audit profession. And when you step back and look at it, it's actually a really interesting case study because, ordinarily, like if you look at soda, okay, people are partial to Pepsi or Coke, right? Like those brands compete. I mean, you're kind of one or the other. You don't just say, man, I want soda, so I want a Coke or I want a Pepsi.
Right.
The audit profession is different, right? There's the big four. Nobody really cares which one of the big four, like the big four brands individually, will anybody out there say, no, I really like Deloitte, but KPMG, don't like
Hmm.
those guys. No, all we care about is that it's a big four auditor, right? So they have this collective brand. The individual brands don't really mean anything, I'd say, beyond what the collective brand means. And they have audit failures all the time. And yet, based on the invective directed at me whenever we accuse a company of fraud, the public doesn't get that. The public doesn't understand that auditors have these audit failures all the time. But more importantly, what the public doesn't understand is what audits of public companies do and don't do. They are not designed to look for fraud. No, they are not. They are designed principally to ensure that the correct accounting standards are applied and that they're
Yeah.
applied correctly. And now in this gray zone world, your gray zone on steroids world, they often don't do that. Like they really seldom dial their clients back. And in fact, we've become aware of instances where it was actually the auditor going to management saying like, hey, under this new accounting standard, you can really book all this revenue here that you would have recognized over several years, And so I would like to see, and so the final thing that the auditors do, and this is the reform, is that they've post Arthur Andersen and Enron, they've set up all of these independent, well, supposedly independent legal entities, right? So they all use whichever Big Four's brand, Deloitte's brand. This is Deloitte, Beijing, and this is Deloitte US. And so money moves freely throughout the structure. People move freely throughout the structure. They're seconded from here to over there. They all have, global training programs. But the moment there's an audit failure, the auditors say, oh, Deloitte US, no, 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 no. This was actually Deloitte Dubai that screwed this up. So no, we're not liable. So because it's an independent and it's an independent member firm of our Deloitte network. And so liability is, quote, ring fenced. And so the public doesn't get that. And I think that that is such a large con. And this really came into play with all these Chinese frauds that were listed here in the US, where, the US side that was, prostituting out the brand, and I'd say was, bears some real responsibility for the many tens of billions of dollars that were lost by US investors in these frauds. They really didn't end up paying much, if anything at all, when the dust settled. So that is, so to disallow that structure where they can claim that these are legally isolated entities that, that alone should bear liability when there's an audit failure, that I would like to see that the ability for them to do that vitiated.
All right. Okay, great. I think a lot of people here would be cheering that on. Okay, so in the remaining minutes we have left, Carson, again, sort of staying on the so what, most of the people, we do have a number of professional investors that watch these videos, but the majority of them are regular retail investors, right? Folks that have worked hard or working hard to build wealth for their family, and they want to prudently grow it. More importantly, they don't want to lose it, in some sort of either reckless investment or probably more likely some big, market correction. Obviously, I think your earlier comment is a very good one for people to keep in mind. Short selling, for the most part, leave it to the professionals. But in a market like this, what's your advice to the average retail investor? And you said, I would just note two things you said earlier. You said, hey, there's still some opportunity here on the long side on net. And also you yourself have found some things to be optimistically long about right now. So in this kind of market, what is your advice to the regular investor?
So notwithstanding all of my issues with passive investing, I think my advice to the average investor is to be long S&P 500 index fund, or
Really,
some other, yeah,
like use it to your
somewhat,
advantage while the game is still working, kind of.
use it to your advantage while it's still working. And again, going back to my comments that these are effectively actively managed, because the S&P is culling the the weakest of the herd, and replacing it with strong younger stronger younger companies. And right now it's a momentum play. And I think momentum, I think that, I think that's working in this environment where you're going to have, we have, I think, still a lot of speculative liquidity out there, as evidenced by, as I was saying earlier, the prices of crypto. I mean, I don't know, at this moment, Bitcoin's like 90,000 a coin. I mean, yeah, it's off the high, but I mean, it's an asset that has no intrinsic value at all. Like, I mean, okay, gas fees, as they call it, for transactions on the blockchain, but that's de minimis, really, de minimis value. So effectively, these things have no value. And when you look and you see that they have real market caps, though, okay, I think there's still a lot of excess liquidity out there. I think it's still US market anyways, dominated by flows of money. And so I think, yeah, you just over the long term, you'd want to be, at least until we start getting to a situation where going back to whether it'll be telegraphed or be sudden, there's a major dislocation. And up until that point, yeah, I think you want to stay long and just don't worry about the short-term chop. And again, discussions about the valuation on these companies is anachronistic. I mean, if you had to buy one of these companies and take it private, and it was substantially all of your money, okay, that's a totally different question, as to whether you're overpaying for it. But the economic values and the stock prices are just not necessarily that connected anymore.
All right. So basically ride the tide until the tide stops rising. Uh, what what will you be looking at? So you said it'll work until there's a big disconnect. Now, of course, folks want to try to avoid riding the tide until you wake up one morning and, oh God, the market's down 20%. If the wake up call is the sort of the crash, are there warning signs you would be looking for to kind of tell you, almost sort of like your earlier example of, Bear Stearns' problems before, things really got going on? Are there, I don't know, whether it's credit spreads increasing or what signs of worry might tell you, hey, it's time to start, you know, leaving the dance floor?
Well, it's impossible to say what exactly the indicia will be, but the problems ultimately will be greatly exacerbated by all of the leverage in the system. So um, there probably will be canaries in the coal mine unless it's a pandemic. So certain businesses failing or appearing to be really stressed, funding getting tight in certain situations. I mean, those are things you just have to pay attention to. And I guess when I went back in March of '08, when Bear Stearns failed, and I decided to sell all of my equity holdings, I was debating with myself, and look, I mean, I was young at the time. I was what, 32, and didn't have kids. So I'm not saying that, if you perceive we're at that Bear Stearns moment, you should freak out and sell everything. Um, but what, as I was debating with myself, oh, am I overreacting? Is this kind of, because I think that's maybe for a lot of investors, that's the thing that's going to get them is, will I feel silly, selling right now? And if everything is fine and, and if I have to go back in a few months and pay higher prices, I think I don't know, to me, the debate internally was, will I feel silly? But what I said to myself was, you know what? If this turned out to be the writing on the wall and you did not act on this, you won't feel silly. You will be furious with yourself for years. Like that's, so I like, to me, that was the debate. And the whole like, you will be furious at yourself for years for having missed something so obvious, immediately won out over the, well, you'll feel silly if you panic and, all your friends held on to their stuff and, gained an extra 10% in the meantime, like yeah, that won out. So I don't know. I suspect, and maybe, and I haven't really thought about this too deeply, so maybe I'm wrong, but I suspect that for a lot of investors who lived through that period of time and did not de-risk at that stage, it was I don't want to seem like I'm silly. I don't want to seem like I'm losing my nerve, like I'm a nervous person. Like, when you see something like that, of that magnitude happen, like it's better to be, it's better to be safe than sorry. That's my
Mhm.
view.
All right. Well, look, Carson, you've got an open invitation here. I mean, we'll have you back on in the future regardless. But if at some point you start seeing some of those warning signs that make you think, okay, this is what I would anticipate if we're getting into a time to leave the dance floor moment, please come on the channel and let us all know about it. Obviously, after you've let all your Muddy Waters clients know first. Now, you talked about a couple of funds that it sounds like you've started because you've seen some real long opportunity in a few places. Sounded like one was in Vietnam. Sounded like one was with a mining sector. Is that precious metals mining sector or a variety of different commodities?
Precious and base.
Okay.
So Vietnam was really that came about because in April 2020, I read the first report about the State Department cables about the Wuhan Institute of Virology and the very bad biosecurity. And it really had me start thinking, regardless of what the accepted origin of COVID will be on the back end of COVID, this is what I was thinking in April of 2020, the world's relationship with China is really going to change. And I said, we're going to see the biggest geopolitical shifts we've seen since World War II, and it's all going to revolve around China. And look, I'm very much on record in April 2020 saying that. And so I think everything that we've seen and are seeing right now ratifies that. But the question was, what's the trade? And, at first we went looking for, is there a big short type of trade here? And the answer was no. Just couldn't figure out which dominoes would fall when. And so shorting this as of April 2020 wasn't smart. But on the long side, so we then asked, well, what do you buy? It was obvious to us that it's Vietnam, that Vietnam will be the single largest beneficiary of this, what we call New World Order, been calling it that since 2020, relative to the size of its economy and markets. Now, India is obviously another beneficiary. And I just got back from a trip there. Well, it was Vietnam and India. And so we're looking at the possibility of expanding our Vietnam offering to be what I'm calling Vindia. It should be probably like 70-80% India, just because the size of the market, relative size of the market's 20-30 Vietnam. But I mean, we know Vietnam very well. We're very excited about that economy and that market. India is overvalued, and I think that matters in India more than it does, in the S&P 500 index. But over the long term, I think India is going to be great as well. But that's how we got into Vietnam. Mining, we started out on the short side. We met somebody who's based in Toronto running mining book at a fund there. His name is Darren McLean. So Darren brought us a short idea. We published on it, worked out very well. He brought us a long idea. We went long and, made like 5x when it was bought by Newmont. And he brought us a few more long ideas over time. And ultimately, Darren decided that he wanted to leave that firm, join Muddy Waters, and help us set up a mining fund. And what we like about mining, or really love about it, especially the junior miners, is that you can get venture type returns, but you get a lot more data upon which to base your decisions than you do in venture. And also it's an area where there's been so little talent that's gone into it since, the turn of the century. Right? Like, how many really smart kids from Stanford have said, "Oh, I know, I want to go into mining," right? It's all been software.
I've seen the
finance.
numbers. The numbers of people going into mining over the past 20 years. It's just like a downward, slide.
Yeah, and so our competition on the allocation side, also because the same thing's been true for people investing in mining. You haven't had a lot of people going in. So it's an area where you can have significant edge, where edge, has not been eroded, probably will not be eroded for quite some time. We feel like we do have, especially working with Darren, we do have that edge. So that's why we like mining. But I think when you look at everything we do as a firm, whether it's the activist short selling, Vietnam, or mining, some people say to us like, "Oh, you seem all over the place," but to me, the unifying theme is we do things that are hard. Like we like doing things that are very research intensive and where there is real edge if you do the work. And information asymmetries can prove to be very profitable. So that's the sort of thing we like to do. So yeah, we're not really all over the place. I like to think.
Okay, yeah. So your core competency in each of those is basically doing your homework to a better extent than everybody else at information asymmetry. All right, so I should know this, but I don't. So my apologies. Your short selling fund, your Vietnam fund, and your mining funds, are those public funds?
No, they're private funds, although because of the registration status, I can talk about I am permitted to talk about the mining fund and the Vietnam fund publicly. Our activist short selling funds, no, because they have different registration status. And this is one of my other pet peeves about, see my earlier comments about the blizzard of paperwork we all have to deal with and the meaningless, pointless rules that are not really addressing the underlying structural issues. This would fall into that camp.
Okay. Well, for people that are interested in learning more about those, where should they go?
So for Vietnam, you can go to muddywatersasia.com. For mining, it's muddywatersresources.com. And if you want to read our short research, activist short research, that's on muddywatersresearch.com. And if you contact ir@muddywaterscapital.com, yes, we have to give 4 URLs, I suppose. We can provide more information on any of these strategies.
Okay, great. Carson, when I edit this, I will put up the URLs that you mentioned as well as the email address on the screen so folks know exactly where to go. Folks, I'll have links to those in the description below this video as well, so you can get there with one click. Thanks for making my job tough by having 4 different ones, Carson, but I
I know,
totally
right?
get the challenges you're talking about here. All right. Well, look, this has been great, Carson. Folks, if you've enjoyed this, please let Carson know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Carson, bear with me for like 30 seconds of housekeeping, and then I want to give you the last word. All right, folks. So obviously, if you're, well, I guess, Carson, the type of people who can invest in these funds, are these for accredited investors only? Do you have limitations like that?
So they're for qualified purchasers, although there might be an exemption for the mining and Vietnam fund. That's for our GC to figure out, because again, when he starts talking about the different categories of exemptions, it's just like the peanuts cartoons when the adults are speaking, and it just turns into womp womp womp. So, but for qualified purchaser, no problem. If you're an accredited investor, possibly okay. We'll have to ask the GC.
Okay. So if you fit that profile and are interested in those funds, again, go check out the links that we just provided a minute ago. If you would like some help in general with your overall financial portfolio in navigating the road ahead, highly recommend that most people watching this, unless you've got a great track record as a DIY investor, that you do so following the guidance of a good professional financial advisor, but one that takes into account all the macro issues that Carson has been laying out for us here. If you've got a good one who's doing that for you, great, stick with them. But if not, and you'd like some help from even just some general advice from one of these professionals, consider talking to one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To schedule one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. The firms will be in touch with you right away. And as a reminder, these consultations are totally free. There's no commitments expected. It's just a free public service that these firms offer to help as many people as possible position as prudently as possible for what may lie ahead. Also, while you're there at thoughtfulmoney.com, don't forget to click the newsletter link at the top of the site and sign up for our free Substack if you haven't already. All right, thanks for being patient, Carson. So, as I mentioned, the majority of people watching this video are just regular people who are just, trying to build wealth prudently but more importantly, not lose it. Any bits of parting words of advice for them as they head off into the rest of 2025?
Oh, wow. Well, I have nothing really profound to say because I'm sure what I'm about to say they've heard all the time, but it's true. I mean, it's a get rich slowly business. Be patient. Yeah, you can look at a company that has great fundamentals and maybe the stock doesn't go up because again, you have to have some flows coming into it. So that's also where those share buybacks come into play. But yeah, I'd say be patient and ignore the short-term chop as being noise. But, as we were talking earlier, if you do see something that you suspect could end up being a canary in the coal mine, of a, cataclysmic or, event or major correction, then yes, it's better to be safe than sorry.
All right. Very well said. Well, Carson, look, it's been great. Thanks so much. Really look forward to having you back on the program again some point soon.
Great. Thank you, Adam.
All right. And everybody else, thanks so much for watching.